You and your wife signed the Giving Pledge last week. Also, obviously, co-founder of the Everglades Foundation, have done tremendous work in Florida, and founder of Robin Hood, which has been fighting poverty in New York City in a tremendous way. So philanthropy-wise, you're already doing extremely well, to say the very least. Now, your next sort of target is corporate America, and you have Just Capital Research on the case for you, as well as an ETF, which we'll get to in a moment. But first of all, tell us why Just Capital is so important.
Well, Just Capital was actually founded about 5 years ago, and I think it's kind of recognizing two problems. And the first problem is that our capital markets are working for some folks, but there's a whole bunch of people that they're not working for, that are being left behind. And so that's the first problem. The second problem is that many of the people, shareholders and CEOs, don't recognize that the first problem is actually a problem. That our capitalists, the way our capital markets work right now, the way our companies work right now, has evolved to a point that's probably not sustainable over time.
Now, philanthropy is massive in the US, as we know, but business is actually 40 times philanthropy. So business could have an exponentially greater impact on this inequality that you talk about. But what about shareholders? Because, you know, you, along with everybody else, would say shareholders, you know, must also be treated fairly by business. Where is shareholder primacy?
Right. So I think that's really what Just Capital is all about, is that if you think about the evolution of capitalism, right? And next year is going to be an incredibly important milestone, because September 13th, 2020 will be the 50th anniversary of when Milton Friedman wrote a very famous editorial that went in the New York Times. And in that, he said, the purpose of business is to make a profit. And that unleashed and unchained CEOs, management, shareholders, et cetera, to go on one of the most incredible journeys that's ever been taken in any society, for that matter. So in 1970, about 6.5% of corporate profits went to shareholders. Fast forward to today, that number's 13%. So they've literally doubled their take of corporate revenue. And there wasn't a plebiscite, there wasn't an act of Congress, there was no malicious intent. It just happened organically as we actually took everything out of the equation of what a true purpose of a company is, other than to make a profit. And so what that did, the consequences of that is we now have wealth inequality 5 times of what it was 50 years ago. We have the top 20 wealthiest Americans have as much net worth as the bottom 175 million Americans. And so we're probably at a point where we have enough fissures, enough problems, enough divisiveness in our society that if we don't address this allocation of resources, so to speak, in some way, shape, or form, I don't think that we're on a sustainable path. I think 43% of people today would vote, there was a poll just out, would vote in favor of socialism over capitalism. I'm a capitalist, so I don't want to see that happen. So I think we've got to get a new direction for capitalism and redefine it.
Part of the problem is performance, though, particularly when a market keeps going higher, and I know you're looking for the market to continue grinding higher. If companies can only gain performance by buying back stock, then, you know, what happens to the other mandates that they might have, their social inclusion, their, you know, let's fight inequality mandates, which really are, you know, they're not mandatory.
Right. So one of the reasons I'm here, we just had a little conference this morning where we announced a collaboration between Just Capital and the Coalition for Inclusive Capitalism. It was so interesting because I got to interview the CIOs of the state of Illinois, state of Florida, state of New York. It was about $500 billion between them. in terms of assets they manage. And at the very end, I said, okay, you know, we just had gone on and we talked about the relationship between shareholders. If you think about the corporate universe, right? You've got shareholders, you've got employees, customers, communities, the planet. Those are the 5 stakeholders in the business world. And so right now, we've had this massive movement over the past 50 years towards shareholders, shareholder primacy, so to speak, to use your term. So in that, I said, okay, it's real simple. We had a tax cut last year. And that tax cut, if we just had a blank sheet of paper and we were starting, that tax cut, ex post, we now know that 80% of the tax cut, which was an American tax cut, 80% of that went to shareholders in the form of 1.1 trillion went of total profits went to buybacks and the balance in dividends. So 80% of that tax cut, that incremental about 300 billion, were also in buybacks and dividends. So I said, I'm going to put you on the spot. Do you think that's the right number? You're a fiduciary. You're managing this for millions of retirees. Was that the right and fair number, or should it be something lower? So first, I said, before I put you on the spot, let me ask the audience. We had about 150 people there. Most were business women and businessmen. I said, what do you think the number should be? And let's break it into buckets. So I said 60 to 80, 40 to 60, 20 to 40, 0 to 20. Before I give you the answer, what's your number?
You're the person who needs to give...
No. We're all going to vote here. I'm going to tell you what my number was. 80% went to shareholders. Vonnie, what do you think? Because if it hadn't gone to shareholders, it would have gone to employees, customers, communities, and the planet. What do you think the number should have been?
50% employees, 50% the planet. I don't know. I don't vote on these things.
Okay. So I asked, go ahead.
I do want to ask you then, at what point government needs to step in? Because there's only so much that corporate America can do, correct? I mean, given that everybody probably gave you a different answer on that panel, at what point does this need to be a policy framework? And have you seen anything from the Democratic presidential candidates so far that excites you, given that the current incumbent put in place tax cuts that didn't excite you ultimately?
Okay, well, I'm going to get to that. I just want to go back to what that audience said. 3 people out of 150 said 80% and up was the right number. About 15 out of 150 said 60 to 80. I'd say 50 people were in the 40 to 60.
Right, so everybody had a different number.
But the average was probably below 50%. Just to put that in terms we can all understand, that means that, and then I asked the CIOs. I got about 70% from the gentleman from Florida, if I remember correctly, 50% from the gentleman from Illinois, 35% from Napoli at New York, so around 50%. So 30%, if you just kind of crowdsourced everyone there, including the guys that managed $500 billion, that the difference between the 80 that went and the below 50, at least 30%, 90 billion should have gone to employees, customers, communities, and the planet. 90 billion of that tax cut. And so, to me, there's a huge message there to corporate boards, to CEOs. Like if I'm sitting on a corporate board, I'm thinking, well, wait a second, was the smell test right on what we did with the incremental profits that we gained last year?
Therefore, don't you need people in the administration and surrounding the administration to enact different, types of policies? And in that case, have you seen any fix to this situation? I mean, should the president be re-elected, or should somebody else, maybe from the other side, get into power?
Okay, so it's easy to default to government policy, and clearly I weigh that in my mind. We started Just Capital because of the power of cultural change. And our idea was to use markets to fix markets. We asked the American public how they what they consider to be a just company. We then take those metrics and apply them with 200,000 different data sets to the 1,000 largest companies in America, and we rank them from 1 to 1,000.
And they get a seal, yeah.
And they get, so customers can see it, investors can see it, prospective employees can see it. It's on our website. Please visit it. So we're trying to use social norming to give you an idea how important and how cultures can change with norms. In Japan, 2016, there was a popsicle company, a very famous Japanese popsicle company that served popsicles through the public school system to virtually every child in Japan. They had not raised prices in 29 years, since 1987. So in 2016, finally, they came out and raised prices. Do you know how they did that? The chairman, the president, the entire management team, plus all the employees came out, bowed down, and apologized to the public for raising prices. Now, there's no government policy that made them do that. There's a cultural mindset of what is right, what is just, that made them do that. We've swung towards shareholders, and we probably need, and the culture's changing right now. You can see right now people realize we've gone too far. It's got to come back. CEOs see it. Hopefully corporate boards will start talking to their CEOs and readjusting the mix.
And I absolutely wouldn't put it past you to actually change the mindset of the entirety of corporate America. You know, you're a one-man crusader who's extraordinarily efficient and effective. So let me ask you this. You do want the stock, I mean, given the trades you have on now, you're anticipating that the stock market will go higher. I mean, at what point does that end? Will we see a Federal Reserve rate cut or some forward guidance signaling next month, next week?
I'll answer that question. I just want to say one thing. Just Capital is real simple. We ask the American public every year. So it's not me, it's not my thoughts on what's fair. Every year we ask the American public, and so there's a guide of the people, for the people, by the people. Americans know what is just, and it's a blueprint for any investor, any shareholder, any company, any CEO of how they should align their views with the American public.
And there's also an ETF.
So it's not me. To get to your point, we're getting ready to have a rate cut. So there's rate cut 101, first cut 101 trades. They're long stocks, at least initially, long fixed income, probably short the dollar, long gold. So that's what you do into the first rate cut. The stock markets they're already trading, right? All those trades are already in process. The question is, how much further are they going to go into and past the first rate cut? I think they're all going to keep going a long way.
So you think in 2019 we might see 50 basis points, 75 basis points of cuts?
Well, so much of it depends on the tariffs, how far we go with tariffs. Remember, this rate cycle was cut short. We never really got the rates that we've gotten to historically to end an economic cycle. They were cut short because of the tariffs. So we really have to see the impact that they're going to have, and whether this next round of tariffs gets implemented, to me, is a huge deal. I would say if they get implemented, if we go to the $500 billion, then I think certainly it's possible that could tip us into recession. We've never seen anything like this in 75 years, right? We haven't seen tariffs since 1929-30. There's no playbook for this. You've got this interconnected global economy that now all of a sudden, for the first time in 75 years, for the first time we're seeing free trade not being expanded but being diminished. And so we just don't know, because we haven't stress tested this system yet. We just don't know what the impact's going to be. So I'm more conservative, so I think it'll have a bigger impact economically than what the market thinks, and could possibly push us into a recession.
Well, exactly. And how do you trade this first rate cut if you don't know whether it's going to be an economy weakening moment or whether it's just an insurance cut?
Yeah, I think we've only seen tariffs. We've only seen this tariff playbook once. It was 1929-30. So you've only got one data point. It's hard. I think whether we impose that next $300 billion is going to be very material for whether that's the tipping point for pushing us into a recession.
Just a couple of more quick questions. What areas of the market are you talking about across the board, or do you look at, cyclicals, defensives? What are?
So I'm a macro trader, and I'm really not trading sectoral that much. So for me, the simplest trades are, I think one of the best trades is going to be gold. If I had to pick my favorite for the next 12 to 24 months, it'd probably be gold.
Where does it go to? Beyond 1400?
Oh, I think if it goes to 1,400, it goes to 1,700 rather quickly. It has everything going for it in a world of rates that are conceivably going down in the United States and going to zero. It has everything going for us. Remember, we've had 75 years of expanding globalization and trade. And we've built the machine around the belief that that was the way the world was going to be. Now, all of a sudden, it's stopped, and we're reversing that. And so when you do something like that, when you break something like that, a lot of times the consequences won't be seen at first. It might be seen 1 year, 2 years, 3 years later. So that would make one think that it's possible that we go into recession. It would make one think that rates in the United States go back towards the zero-bound level, and of course, in that situation, gold's going to scream. And it'll be the antidote institutionally for people with equity portfolios.
And of course, commodities were the place where you started originally. Treasuries-wise, what kind of duration are you looking at? What types of treasuries trade are you putting on? You say long treasuries, but that's very broad.
Again, the way that you would trade this is you'd be long the front end of the curve, even though it's already priced through. If you truly believe that we're going into recession, you just stay in the front end of the curve. Again, I think what happens here in the next 2 or 3 weeks with regard to the imposition of this next round of tariffs and $300 billion is going to be really impactful for how you trade those assets. I think there's a big delta on whether the next round of tariffs happens or not. Delta on the economy, delta on the markets.
If there were to be a change of regime in the next election, it might affect some of the just capital companies.
Right.
What would you say are the probabilities that there will be a change?
You're trying to ask me to forecast a presidential race?
I am.
Okay. I'm not good at that. I just read what the pundits say. I'm going to duck that one because I don't have a clue.
All right, Paul, we'll have to get you back on to closer to the time to see how you're trading around then.